So today was the worst global sell-off of stocks we've seen in about 2 months. For visual reference, here's a heat map of the daily price change for each of the stocks in the S&P 500. Well, this certainly isn't as bad as the sea of red we saw back in February, but it did prompt me to want to make this video, which is 3 reasons I believe that the stock market could crash 20% or more. I'm not pretending to know when the next stock market crash is going to happen. No one does. However, I do want to walk you through some resources which explain the 3 reasons why I believe the stock market is particularly vulnerable to a crash today. After walking through these reasons, at the end of the video, I'll share what I'm doing to protect my portfolio against downside risk and to position myself to potentially profit from the next crash. So with that being said, let's jump into it. So what you're looking at right now is the market heat map of the S&P and its daily performance for today. What we saw was that the sell-off was concentrated in growth stocks, so technology stocks as well as healthcare, pharmaceuticals were hit pretty hard. In this case, the FANG stocks, so Facebook, Amazon, Netflix, and Google, were some of the big losers for today. This sell-off was global, so international stocks weren't spared either. In this case, Alibaba was down about 4%, JD about 3%, Baidu about 3%, and iQIYI about 6%. So that was the global stock market heat map. If we take a look at this heat map, this actually looks at all the exchange traded funds, which can help give a sense of which groups of stocks were hit the hardest. And I did not mention this, but if you're not familiar with this layout, this is FinViz or financial visualizations. Just go to the maps section and you'll be able to see exactly what you're seeing here. Specifically, I want to highlight this section here, which is a comparison of how value stocks perform today with that of growth stocks. So if you look, for instance, at the Vanguard Value ETF, it was down about 0.2% today. Compare that to the equivalent Vanguard Growth ETF, which was down about 1.5% today. Understand that it's no guarantee that value stocks will necessarily outperform growth stocks during a crash or correction. However, growth stocks tend to be more volatile, so you may see larger swings when the market is down. So I want to get into a little bit of why we're seeing this sell-off. And ultimately, one of the large drivers or explanations for it is the increase in interest rates. This is a graph of the US 10-year Treasury yield, and currently the yields have risen to a point which is the highest it's been in 7 years. Now, these increasing interest rates are one of the reasons why I believe the US stock market is more susceptible to a crash in the future. If you take a broader look, even though interest rates have been rising somewhat, they're still very low compared to historical norms. Interest rates act like gravity for the financial markets. Warren Buffett explains this concept this way, that interest rates act on financial valuations the way gravity acts on matter. The higher the rate, the greater the downward pull. That's because the rates of return that investors need from any kind of investment are directly tied to the risk-free rate that they can earn from government securities. So if the government rate rises, the prices of all other investments must adjust downward to a level that brings their expected rates of return into line. Conversely, if the government interest rates fall, the move pushes the price of all other investments upward. Given that if we see this trend of rising interest rates continue, this will be the first time in a period of over 40 years that we've actually had this occur. Since the early 1980s, financial markets have been benefiting from a declining interest rate environment. The lower the interest rate, the more likely an investor will turn to riskier assets in order to try and get a higher rate of return. With rates near historic lows, we've seen a lot of movement into the stock market. However, should that trend start to correct and we see more attractive yields on bonds and fixed income investments, we might see more of that money move away from the stock market and back into the bond market. Additionally, these rising interest rates mean that the cost of capital or the cost to borrow for these companies is going to increase as well. While this shouldn't be an issue for companies with investment opportunities that offer a high rate of return, it could be problematic for companies that were taking advantage of the low interest rate financing to pursue projects that had a lower rate of return. With higher interest rates, many of those projects might not be as profitable as they once thought. Speaking about profits, this leads me into my second reason for potential concern. So some people will point and say that the recent returns in the stock market are justified because we've seen a commensurate increase in corporate earnings. This graph shows that from around October 2015 to where we are today, we've seen approximately a 25% increase in overall corporate profits. However, in that same period of time, the S&P index has increased by 50% more than doubling the rate of growth in corporate earnings. This higher rate of price appreciation is reflected in the overall price-to-earnings ratio of the S&P 500 index. The Shiller PE is a ratio of the current price of the index to its historical earnings over the last 10 years. By this metric, the US market is well above historical valuations, and in fact, the only time in past history where markets have been more overvalued was during the 2000 dot-com bubble. We've since surpassed the valuation seen in the 1929 stock market bubble, and we all know how that turned out. Now again, I'm not saying that there necessarily will be a crash, but if you look at periods where we've had extended valuations rise very quickly, in this case 1929, as well as during 2000s, they also tend to correct rather quickly as well. Now there's another valuation metric, which is called the Buffett indicator, which also signifies that we are well in an overvalued territory. The Buffett indicator is effectively just a ratio of the total stock market capitalization over the nation's GDP. These are shown in this graph here, where the blue line represents the total market capitalization and the green line represents the GDP. That ratio is shown here, and as you can see, back in 2000, we hit a peak of 148, and today we have now matched that peak. Now using this data, we can estimate a range of what the likely returns are for the index over the next 8 years. In this case, if we see a return to more historical levels of valuation, we should expect around a negative 2.5% annual return, which includes dividends, for the next 8 years. Now that's visually represented here in this graph, which at each point in time projects what the returns will be 8 years in the future at different levels of stock valuation. Take, for example, the low valuation period of the 1980s. In this case, what this graph is showing is that based on valuations on March 30th, 1980, if 8 years from now we saw a total market capitalization over GDP of 40%, we should expect around a 17.8% annual return, including dividends, on the index over those 8 years. If 8 years from now we were able to see even higher levels of valuation, for instance, if the total market capitalization over GDP was 80% in 8 years, we would then expect to see roughly a 27% annual return on the index. Now what the yellow line represents is the actual 8-year return that was seen from March 30th, 1980 to March 30th, 1987. Over that 8-year period, the index actually returned 17.9% annually, including dividends. Now, what you can see from the full chart is that most of the time historically, the actual return has fallen within these levels of estimates between a low valuation estimate, which is the green line, and the high valuation estimate, which is the red line. In this case, this graph gives us an idea of what our future returns will be, at least for the next 8 years, based on our current valuations today. Now you'll notice that our valuations today are similar to that of the dot-com bubble. Now if you invested in the index in March 2000 and had access to this, then you could estimate that your future returns over the next 8 years or so would be between 4.5% and negative 8% per year, with the midpoint being around negative 0.3%. In this case, the actual return was relatively close to that midpoint and was basically flat, or around 0.3% per year. If you look at where these estimates are today, it's not a pretty picture. Effectively, if we're to see a return to more normal valuations around that 80% total market cap to GDP threshold, then we're expected to see a negative 2.5% return annually for the next 8 years. Even if valuations were expected to remain relatively high at around a 120% ratio, it's only predicted that we would get a roughly 2.3% annual return. Seeing these low predictions is one reason why I'm hesitant to invest passively in an index fund at this time. While valuations could certainly remain high or even increase further, there's a lot of risk in the indexes at these valuation levels. If you want to see this and explore this for yourself, you can go to gurufocus.com under market valuation and check out the Buffett indicator. So the first reason I'm concerned about a stock market crash is the rising interest rate environment. The second reason is the high stock valuations within the US stock market. And my third concern is the rise in the use of passive indexing as well as algorithmic trading. JP Morgan estimates that only about 10% of trades are done by individual investors based on stock fundamentals. This implies that the remaining 90% are either made up by algorithmic trading or by passive indexing strategies. With more passive indexing as well as more algorithmic trading based on momentum, these crashes could potentially happen further and faster than they have before. If you need any evidence, just look back to the recent correction back in February. Over the course of a week, things escalated extremely quickly and the indices were down 10% in no time. Now, I'm interested in hearing your thoughts, but from my perspective, there's nothing stopping anything like that from happening again today. Given all that, one thing we've also observed is that passive indexing strategies tend to outperform active investors during a bull market, but then tend to underperform active investors during a bear market. Take a look at the active mutual fund performance versus that of the S&P index. Notice that in bull markets, so from 1994 to 1999, that passive indexing outperformed active. However, once things turned south, as they did during 2000 to 2003, you see active investing actually outperforms passive. Active investing outperformed during the financial crisis, but then has since been beaten by passive investing during this long bull market. Understand that this outperformance is cyclical and normally occurs when you see a change from a bull to a bear market. This is primarily because passive investing is just that, it's passive. Passive indexing will continue to invest in companies even if they're trading at high valuations. If those valuations continue to increase, so will the share price, and passive indexers will be rewarded. Active investors who may be more conservative get left behind by the rise in valuations, but then tend to outperform when valuations come back to reality. And the third reason why I'm concerned for a crash is that the passive indexing explosion has made the market more sensitive. With so much money in passive indexing today, I know this trend can only continue for so long. Eventually, it will reverse, and that likely correlates to a bear market. Now, understand that I'm not saying you shouldn't invest in the market at all. However, I do think it'd be prudent to be a bit more cautious during these times. Given all that, here are a few things that I'm doing to help protect myself from downside risk, as well as position myself to potentially take advantage of any opportunities that another market crash might bring. The first of which is relatively simple, which is just increasing the proportion of investable cash that I keep within my portfolio. Cash is a very powerful tool during a down market and gives you the dry powder needed to take advantage of opportunities that only come a few times during a lifetime. Another thing you could do is to hedge your portfolio with non-correlated assets. This can include gold and gold miners and some option strategies if you're so inclined. The idea with these hedges is that if you allocate a small portion of your portfolio to them, they can help offset the losses from the remainder of your portfolio should you see periods of higher volatility. Another strategy which I'm actively pursuing right now is to tilt your portfolio more towards defensive, value, or even dividend stocks. These types of stocks tend to perform better during down markets relative to high valuation growth stocks. If your portfolio consists primarily of growth stocks, take a moment to consider if you should transition some of that to more defensive or value stocks. In addition, stocks that pay a healthy, consistent dividend can be one source of returns when the rest of the market is going south. And a fourth thing you can do is to be less reliant on passive investing vehicles like index funds. Understand that the valuations of these index funds, as we discussed earlier, are at historical highs. If you want to try and protect yourself more from downside risk in a bear market, you could potentially consider scaling back some of your passive investments and instead use that capital in some of the options I've mentioned before. And the final thing you can do is have the right mindset before the crash happens. Understand that the market could certainly continue to go upwards, but don't be surprised if you do see a market crash or correction. Understand and know the reasons you're investing in the companies you are today, and don't panic or get emotional if you see the price of those stocks drop. Have a plan in place and some cash on hand so you'll be ready to take advantage of opportunities in the market when everyone else is headed for the exits. So what are your thoughts? Do you think the market is at an elevated risk for a crash right now? And if so, what are you doing to help protect yourself against it? If you've made it this far and haven't yet subscribed already to the channel, definitely click my face to do so, and I'll have a recommended video for you over here in just a moment. Until next time, thank you all for watching. My name's Michael, and I will see you in the next video.